Welcome to a new episode of Inside the Economist's Mind.
Great to be here.
Today, we're diving deep into the concept of economic recession. We've got a set of resources here based on what you, our listeners, have asked about.
Yeah, it's a topic that comes up a lot, and it's definitely important. You've flagged this phenomenon, and we really want to unpack it for you.
Right, get beyond just a simple definition.
Exactly. Our mission, if you like, is to figure out what a recession really is, how economists actually identify one, and maybe most importantly, why it matters so much to individuals, to the whole economy.
And to do that, we'll be looking at, well, explanations of the business cycle, different definitions of recession from various bodies, and also some history downturns, recessions, even depressions, specifically here in Australia.
It's quite a mix, should give us a good picture.
Okay, so maybe the best place to start is the big picture, the business cycle.
Good idea.
Our sources explain that, normally the economy grows over time, but it's not just a smooth upward line, is it?
No, definitely not. It fluctuates. There are these ups and downs, peaks and troughs in activity, and that pattern is what we call the business cycle.
So it's like a rhythm.
Precisely.
Ah,
And you can generally break it down into four main phases. You've got the expansion phase first.
right, that's when things are picking up.
Yeah. Demand increases, businesses start hiring more, wages and prices tend to rise a bit. That keeps going until the economy hits a peak.
That high point.
That's the one. Marks the end of that expansion. Then, naturally, what follows is the contraction phase.
Which is where recession fits in.
Usually, yes, this is when things slow down. Demand weakens, businesses might get cautious, maybe lay people off, and wage and price growth slows.
And that phase continues until...
Until we hit the trough, that's the bottom point of that particular cycle, before things hopefully start to pick up again in a new expansion.
Okay. And one of the visuals we looked at, the one showing actual versus potential output, that helps explain this, right?
Absolutely. It shows this idea of potential output. Think of that as what the economy could produce sustainably, using its resources, factories, workers efficiently, without causing too much inflation.
But the actual output, what we really produce, it wobbles around that potential line.
Exactly. Sometimes we're above it, sometimes below. Those wobbles are the business cycle in action.
Got it. And it's not like these phases are always the same length either.
Not at all. Expansions usually last longer, sometimes much longer, than contractions.
Yeah.
And how long a cycle lasts or how severe the downturn is can depend on lots of things. Policy responses, global events, you name it.
Right. So let's zoom in on recession itself. You mentioned it fits into the contraction phase, but nailing down a definition seems tricky.
It really is. There's no single, universally agreed upon definition, which might surprise some people.
But there are common threads.
Definitely. Most definitions involve two key things: a noticeable drop, or at least a significant slowdown, in economic output, usually measured by real GDP.
That's the total value of everything produced, adjusted for inflation.
Correct. And the second element is usually a significant jump in the unemployment rate, people losing jobs.
Okay. Now, the one you hear about most often, probably in the news, is the technical recession.
Yes, the famous one. 2 consecutive quarters, so 6 months of negative real GDP growth, fall, then fall again.
It's neat, easy to report.
It is. And it's interesting, as our sources point out, Australia had this incredibly long run without technical recession, from the early 90s up until, well, recently with COVID. It's quite unusual compared to our own past or other similar economies.
Makes you wonder why. But is that technical definition always the best measure? The sources seem a bit cautious about it.
Yeah, there are definite drawbacks. I mean, think about it. Growth could be positive, but just barely, say, 0.1%.
Technically not a recession.
Right. But the economy could still feel pretty weak. Businesses might still be shedding jobs. People could be struggling. So relying only on that 2-quarter rule might miss the real pain sometimes.
And the GDP numbers themselves can bounce around a bit.
They can. Certain parts of GDP, like inventories or even exports sometimes, are quite volatile. Plus, those initial GDP figures often get revised later as more data comes in.
So you could think you're in a recession and then, oops, actually you weren't. Or the other way around.
Precisely. It can give false signals. That's why economists often look at other things too.
Like what? Our sources mention GDP per capita.
Right. So instead of just total GDP, you look at GDP divided by the population. If the population is growing faster than the economy, even if total GDP is slightly up, GDP per person could be falling.
Which suggests living standards aren't improving or are even declining on average.
Exactly. It gives a different perspective. Another approach mentioned is looking at GDP but maybe excluding really volatile sectors like farming. to see the underlying trend in the rest of the economy.
Makes sense. Then there's the way they do it in the U.S., the NBER, National Bureau of Economic Research. Their definition sounds broader.
It is much broader. They don't just look at GDP. They define a recession as a significant decline in economic activity that's spread across the whole economy. So not just one sector and lasts more than a few months. They pinpoint a peak and then a trough.
So it's not just a formula, it's more of a judgment call based on lots of indicators.
That's a good way to put it. They look at employment, industrial production, retail sales, incomes, a whole range of things. It often lines up with the technical definition, but not always.
But it takes them longer to make the call, right? They don't announce it immediately.
No, they wait for the data to settle to be sure about the peak and trough dates. It's more retrospective.
Okay. And one other approach mentioned was focusing just on unemployment, like if the unemployment rate jumps by a certain amount.
Yeah, that's another rule of thumb some people use. The appeal is that unemployment data comes out relatively quickly. It's usually pretty reliable, less prone to big revisions than GDP.
Simple, timely. Sounds good.
It has advantages. But the limitation is it might not capture everything happening in the job market, like underemployment people who have a job but want more hours and can't get them. The unemployment rate alone might miss that kind of weakness.
Right, that's a really important point. Okay, so we have recessions with all these definitional nuances, but then there's the word depression. How does that differ?
Think of a depression as a recession on steroids, basically. It's much, much worse.
How so?
It's about scale and duration. A depression involves a far deeper fall in economic output. It lasts much longer, potentially years, and unemployment reaches incredibly high levels and stays there for a long time.
And often it's a global thing.
Very often, yes. The negative impacts tend to spill across borders, affecting multiple countries quite severely. Some definitions even explicitly say it has to impact more than one economy to be called a depression.
Okay, so knowing these definitions helps, but seeing how they played out in Australia's history probably makes it much more real.
Absolutely. History gives us concrete examples.
The sources detail quite a few downturns. Let's start with the recessions. The mid-1970s seems like a key one.
Oh, definitely. 1974-75. A big part of that was external, the massive OPEC oil price shock. Prices quadrupled.
Wow, that must have hit hard.
It did, cause huge inflation globally and here. Plus, we had our own domestic wage pressures adding fuel to the fire. And because other countries were struggling, demand for our stuff fell too.
So output fell, jobs were lost.
Yeah, and we got that nasty combination called stagflation, stagnation, meaning low growth or recession, plus high inflation. Unemployment hit about 5.5%, which was high for the time, and inflation soared to around 18%.
18%. Ouch. Okay, then fast forward to the early 80s, 1982-83, another recession. What drove that one?
Well, that high inflation from the 70s was still a problem. It had become kind of entrenched. So central banks worldwide, including ours, were really tightening monetary policy, jacking up interest rates to try and beat it.
Trying to slow things down deliberately.
Exactly. But that, combined with weak global demand and, crucially for Australia, a really severe drought hitting the farm sector, it tipped us into recession. Unemployment went much higher this time, peaking around 10.5%.
That's a big jump.
It was. Interestingly, though, the recovery afterwards was quite quick once the drought broke. And things like floating the Aussie dollar around that time, plus other reforms, probably helped.
So policy and external factors again. And then the one many people listening probably remember, the early 1990s recession.
Yes, 1991-92, often called the recession we had to have, though that's debated. This one was largely driven by domestic policy efforts to cool down what was seen as an overheating economy, especially a booming property market, and get inflation down.
So high interest rates again.
Very high interest rates.
Yep.
The issue was it took longer than expected for those high rates to really bite and slow things down. And just as they did, unfortunately, major partners like the U.S. also fell into recession, hitting our exports.
A double whammy.
Pretty much. Unemployment climbed even higher this time, just over 11%. A really tough period for many Australians.
Very tough. Now, beyond these recessions, Australia has also experienced actual depressions, which sound even more severe. The Great Depression of the 1930s is the obvious one.
Absolutely, the defining economic event of the 20th century globally. In Australia, its worst phase was roughly 1929 to 1931. It was incredibly deep and long-lasting.
And the social impact.
Devastating. Remember, this was before modern welfare systems, unemployment benefits as we know them. So mass unemployment, estimated perhaps between 20 and 30% at its peak, meant terrible hardship.
20 to 30%. It's hard to even imagine.
It really is. Though, interestingly, the sources suggest Australia, while hit very hard, might have fared slightly less badly in pure economic terms than, say, the US or Germany.
Still catastrophic, though. And there was an even earlier one, the 1890s.
Yes, the Depression of the 1890s. Perhaps less famous now, but incredibly significant for Australia's development. It came after a big boom in the 1880s, fueled by resources and property speculation, a lot of it financed by British investment.
And then the money dried up?
Yeah, foreign investors pulled back.
Right.
Australia didn't have its own currency then, couldn't easily cushion the blow. Wool prices collapsed, a massive export earner, and there was a huge financial crisis. Runs on banks, many banks failed.
Sounds chaotic.
It was. And the sources suggest the fall in production and the level of unemployment might have actually been worse in the 1890s than in the 1930s here.
Really? Worse than the Great Depression?
Potentially, in terms of the depth of the economic fall. And it had massive long-term consequences spurred on the trade union movement, led to the formation of the Australian Labor Party, and was even a factor pushing the colonies towards federation in 1901. A truly transformative crisis.
Wow. That puts things in perspective. Now, more recently, we had scares like the global financial crisis, the GFC in 2008, 2009.
Right. A huge global shock originating in the U.S. financial system. Many countries went into deep recessions.
But Australia didn't, technically.
Technically, no. We had 1/4 of negative growth, but bounced back. Australia weathered the storm remarkably well, comparatively.
Why was that?
A few key reasons are usually cited. Our banking system was better regulated and less exposed to those toxic assets. China's economy kept growing strongly, buying our resources, and the government implemented a pretty large and fast stimulus package. Unemployment did rise, peaking near 6%, but it could have been much worse.
Okay. And then the most recent major downturn, COVID-19.
Very different kind of shock. Not economic imbalances, but a health crisis forcing lockdowns.
And the economic impact was immediate and severe.
Extremely. GDP fell about 7% in just 1/4, the June quarter of 2020. That's a massive sudden drop. Unemployment shot up, underemployment too. But then as restrictions lifted and with huge government and RBA support, the rebound was also unusually fast, a very unique V-shaped event, driven by external health measures rather than underlying economics.
So these historical examples really show the different shapes and sizes recessions and depressions can take. But the sources also stress the long-term damage they can cause, right? It's not just about the months of negative growth.
Absolutely not. The costs can be really large and last for years, even decades.
Like long-term unemployment.
Exactly. When people lose jobs in a recession, especially if they're out of work for a long time, it gets harder and harder to get back in. Skills can get rusty. Employers might be hesitant to hire someone with a long gap in their resume.
That scarring effect you hear about.
Precisely. Plus, recessions often accelerate structural changes in the economy. Some industries shrink, others grow. People whose skills were tied to the shrinking industries can find themselves permanently displaced. This can lead to a higher underlying rate of unemployment even after the recovery.
And just the sheer economic hardship for families.
Immense. And it's rarely spread evenly. It can affect people's health, kids' education, social mobility. The impacts can ripple through generations.
There's also the loss to the economy itself, right? Businesses going under.
Yes. When businesses fail, especially innovative ones or key suppliers, that productive capacity is lost. It's not easily replaced. That puts a dent in the economy's potential growth path permanently.
And then there's the government's budget.
Right. Recessions hit budgets from both sides. Tax revenues fall because people and companies earn less. Government spending goes up on unemployment benefits, maybe stimulus packages. So public debt tends to rise significantly during and after recessions.
And it's not always the same groups hit hardest in every recession.
No, it varies. Sometimes younger workers or those with less education are hit worst. Other times, maybe prime-age men in manufacturing or construction suffer more. It really depends on what caused the recession and which sectors are most affected. That graph we looked at, showing unemployment changes across different downturns, really highlighted how varied the impact can be.
It's quite sobering stuff when you look at it all together.
It really is.
So wrapping up our deep dive today, it seems clear that recession isn't just one simple thing. There are different ways to define it, different ways it feels.
Definitely. But the core is usually that significant economic slowdown and rising unemployment.
And looking at history, especially here in Australia, shows these aren't just abstract concepts. They're recurring events with really significant, sometimes devastating, and often long-lasting consequences for people and the economy.
Understanding these cycles, the definitions, the history, the impacts is just crucial. crucial for policymakers trying to steer the economy, and honestly crucial for all of us trying to navigate our own lives and financial decisions.
Yeah, absolutely. So maybe a final thought for you, our listeners, to chew on. Considering all these different ways to measure a recession and the deep impacts they have that go beyond just GDP numbers, what do you think is the most vital sign to watch to really gauge an economy's health? And knowing these downturns happen, what responsibility, if any, do individuals have to prepare themselves for potential economic rough patches ahead? Something to ponder.